Shane, how's it going?
I'm hungry, dude. How are you?
Doing well. Sitting here and I'm wondering, did we just start a new bull market or is this just a fierce bounce?
The bear
So,
market is over again for like the third time this year.
yeah, we'll get into it here, but today's October 6th, and without further ado, let's just hop right into the charts here. So, first one, SPY, we took a pretty solid bounce off that level we were talking about last call, just prior low, and where this goes, I don't know. We have the non-farm payrolls job or a number coming out tomorrow, and I don't know. It's always like, well, if it misses, is that positive? If it exceeds, is that positive? So I don't gamble on that stuff, but what are you seeing in the
Oh,
market?
nobody knows. I don't care. I wouldn't place any big bets before any data like that. I just wait for the data and then see how the market behaves and adjust accordingly. So that's how I trade that stuff. Always with tight stop and yeah, we got, I think most importantly, CPI data come in, what, is it a week from today? Is it on the 13th? I haven't looked at that calendar, but that sounds right. I think the 13th. Sometime next week we'll get the most up-to-date CPI data for September, and that will, I think, have a bigger impact on things. So I think a lot of people are probably just waiting for that. And I mean, there's always volatility around those other events that you mentioned, but I'm not expecting too much movement. I think more likely what happens is the market just kind of consolidates right here around this 375 area, probably doesn't go above 380. And then as soon as the MACD, the momentum switches back to negative, it'll drop hard to a fresh low. That's kind of my base case expectation, but who knows? We'll see.
Yeah, and I think same here. When we get a rally that's that fast and fierce, it's just going to take a few days, I think, where you get some sideways action.
I mean, that
And
rally wasn't anything compared to the downside, though. Like, I don't know why do people talk so much? I mean, even you're talking like there's something bullish that happened over the past couple of days. You didn't even recover half of what you lost since the last top. I mean, to me, that's not a fast and fierce anything. That's just like, it's just I don't know. Maybe you see it differently, dude, but I don't. I don't know. That's nothing. That's hard. You can't even see it. Like if you zoom in, if you go to the next slide, you can see a little bit of a move. But on this chart you're looking at, I see nothing.
yeah, and the big thing here I was just going to go to next is the screen circle. So downtrend resistance line. But you're correct. It was fast and fierce in the context of if you're a day trader or something, that was a pretty good move.
Yeah,
But
I'm not.
in the context of an overall bear market, it was just a blip on the screen. And, my vote is a lot more short covering than any true buying.
Yeah,
But
I don't know. I don't think we have too many day traders following this chat, so that's an irrelevant thing to me.
yeah. And so here we are, just zoomed in on that level. And again, you see that. So decent little bounce here, but we have not broken through any downtrend resistance. I mean, nothing's changed in the picture.
No, we're a couple days removed from the low of the year in a bear market with terrible economics and fundamentals. So this is just another opportunity to sell stuff, in my opinion. There's always opportunities out there to buy. There's certain stocks that if you've held them for the long run and you haven't stopped out of them yet, this might be a good opportunity to add for the long run. We'll get to a few slides later that seem to indicate, over a longer time frame, maybe a year, we might be in a good spot to be buying here. That doesn't mean you're not going to show losses on a buy here, in 6 months, but 12 months from now, chances are we're going to be a little higher. That's my guess. So bear
Hmm.
market won't last forever, not even this one. And I think we'll get to again some slides in a few minutes that kind of show you where we think this thing could finally start turning the corner. So for now though, S&P 500 is stuck in a bear market, stuck in a downtrend. This is not a buy the dips type of market. It is a sell the rips type of market. So that's what I'd be looking to do.
Yep. And Q's, same thing. No real difference there. So just stuck right back in the downtrend channel. Nothing to add to that.
I think as of last week, Q's hadn't made a fresh low for the year yet when we did this call. But yeah, if you go to the next slide, you'll see pretty clearly we made a New 2022 low for Qs too, so followed the S&P 500 this time, and got a bounce too, but stuck in this pretty clean channel to the downside. So last time it broke out of the channel to the upside, it lasted about a month and a half, and then now stuck in a new down channel. This is how bear markets work. So no surprise here until the Fed backs off of their hawkish stance and inclined to raise rates mentality. Q's is in the doghouse.
Yep.
QQQ meet woodshed.
Definitely. And then here's our 60-40 portfolio, which has not fared well in this environment. Traditionally it would have, but things change in the market, and I think that's what people need to remember is that the history might rhyme, but it certainly does not hold true all the time. So this is one of those examples. So 60-40, down what, 21%?
21.3 now.
Yep.
Yeah, the historical correlations don't always hold. So, I mean, everybody does their 60-40 study based on the past 30 years, which was 30 straight years of a bull market for bonds. So yeah, every time stocks go down, bonds were going to do well because they were in a 30-year bull market. Things have changed now, and I added TLT, the pink line, to this chart. TLT, which is the long-term government bond, is even worse than LQD. And that people who have a 60-40 portfolio, they have some corporates, which are represented by the LQD, and they have some governments, which are represented by the pink line. So depending on how your portfolio is designed, how the bond side of the portfolio is designed, might be even worse than 21.33%. So
Yep.
I don't know. You talk to more prospects than me. You still see a lot of people with this type of portfolio?
Absolutely. Either that one or just a smorgasbord of stocks and mutual funds.
I was
And
gonna say, what you talked to somebody recently that had like, how many stocks did they have?
400, I think. So
400 stocks from our friends over at Fisher Investments. What a joke. Who does that? I can't believe people would put, Kyle and I were talking about it a little bit a couple days ago, but if you have 400 stocks, you have a shoebox full of baseball cards, and you're hoping that one of them is like a Mickey Mantle rookie card or something. It's just no focus. Why not just buy the SPY and call it good? That's 500 stocks by itself, all in one ticker. Much
yep.
easier to maintain. I mean, I'm
Yep.
not advocating for either of those things. That's certainly not what we do for our clients. But my goodness, nobody's managing 400 stocks, by the way. Nobody, I promise. Nobody's doing fundamental and technical analysis on 400 stocks every day. No way.
Yeah, quite the list, and makes it hard to navigate an environment like this when you just wonder, well, what do you sell? I mean, that's a lot
Yeah.
of them. So
And I wish I had made a
it,
slide about it, but all your alpha comes from your best ideas anyway. We should talk about that sometime. Like, there's no reason to have more than 20 stocks in a portfolio. And the more, you want to concentrate your best ideas. That's where all of your alpha or your outperformance comes from. So anyway, moving
yeah.
on.
So we'll hit on that next time maybe. But
And I'm sorry
it,
for eating. I'm just too hungry, so I'm gonna eat some food while we're talking here. Hopefully, it's not too distracting for people.
not a problem. And so here's a big one, crude. So OPEC met, and it's mixed. I'm not an energy analyst. I've gotten the idea that they cut, I think, 2 million barrels on the quota, which they weren't meeting the quota anyways.
They never
But
do.
what they certainly did not do was agree to pump out more oil. And we have an article following on this, but the powers that be have tried to kind of pressure them into increasing production here in the US, and it's just kind of amusing. We are now held to foreign powers to give us our oil, and that's what you're seeing here. So
Which
pretty
is
powerful
ridiculous given that
thrust.
we export oil from this country. So what's the deal? I mean, why do we even care what OPEC does? The market seems to react to it, but it's just amazing to me that we haven't invested more in refining our own oil production. Like we send the oil we produce out to other places, and then we import oil from, Middle Eastern countries primarily and refine that. It just seems like a silly way to do it, but
But
Anyway, I didn't mean to interrupt. What were you saying?
uh, the takeaway here now is we're going to see about this is the line in the sand. So I would expect some consolidation here. That is totally normal. But if we break through that and move higher, you better watch out for XLE. I mean, that thing's already on a tear, but uh, you start adding that, I don't know. I mean, oil could get back up into this 112 area. And, in response to that OPEC news, Biden kind of moved forward with releasing oil from the SPR. So it could
Which
get
won't do
interesting.
anything. Which won't
Nope.
do anything. It's not even the right kind of oil. I
It
mean,
it won't do anything to the current price of oil, but I'll tell you if that runs empty, then you could really see a environment there where not only is it just dangerous for us, helpful politically, but man, times of war, the last thing you want to do is run out of oil.
yeah, it's irresponsible and short-sighted is what it is.
Hmm.
Um, but yeah, it looks like we're running into we broke out of we broke above that purple line, which was connecting the lower highs. So broke out of the downtrend for now. We'll see if it sticks or if it's kind of a fake deal and drops back down because now we're hitting that 50-day moving average and that could act as some strong resistance too. So yeah, what I'd like to see is maybe a few days of consolidation, above 85, um, kind of drop down to that purple line and then and then ramp higher into that 200-day area around 96. So, um, if oil does that, look out for inflation too, because that will
Yep.
also reaccelerate, and that's not going to be good for anybody.
Nope. And
It is funny though what you mentioned, like how OPEC just doesn't care what Biden says. Like, oh, will you please increase production? And they come out and cut it by 2 million barrels. By the way, they will not cut by 2 million. Um, they'll cut by they'll cut by like 60% of that amount.
hmm
Is probably what they'll do. So
and
they're OPEC is like, you know, they're great liars. They're very good liars. So
the funny news we'll hit on the article later, but just announcing a possible investigation into antitrust practices done by them, and they're a cartel. I mean that's what they do,
that's
So,
why I don't trade oil.
but well, energy, man, it came down there, and what a time to get in. And now it's testing this uptrend resistance line, and you could say it's breaking out today, but
Yep.
it just when you don't know what sector to go with, you just find the one that's doing the best in bear market. And you can bet that not only will it hopefully perform in a bear market, but when that bear market ends, look out.
It's still cheap too. I mean, XLE is still cheap. The energy sector overall is still cheap on a relative value basis, even to itself, in its own history. So I mean, it's got all the momentum and it's cheap. Why would I this is the best place to be hanging out, and yeah, energy just looks like the place to be this year. Energy and US dollars.
Yep.
Those are the place to be, for sure.
And then, Shane, we have an emerging one here, Bitcoin. You pointed this out to me, but there might be a little hope for the bulls out there.
Might be time to add it back to the watch list at least. I don't think I'm gonna take a big position here, but so this is a zoomed out view. We'll zoom in on the next one, but the reason I wanted to show all the way back to November is because that downtrending purple line connecting the lower highs has been in place since November, and for the first time since November, it finally breached yesterday. We're already got some pretty positive momentum that's starting to kind of decline a little bit. So declining positive momentum. What I would expect is sort of another maybe week of sort of holding that 17,500 area, have the momentum shift back to negative, and as long as it shifts back to negative and holds the 17,500 on the next uh, positive momentum cross, I would expect Bitcoin to make a nice run. So, so we're getting close. I'm not there yet, but you can see that green circle kind of shows that we're above that trend line ever so slightly, and I kind of expect it to fail on this run. Like I said, just kind of consolidate around this, just above this 17,500 level. And then on the next positive momentum cross, I think that might be a good time to take a stab at some Bitcoin. So, it's constructive anyway. I'm not super bullish, but I definitely am going to be watching it. And there's some stocks you can watch too, like MARA, the symbol MARA, Mara, is a good one to watch. Coinbase, COIN is a good one to watch. I don't know about that MicroStrategy. They own a bunch of Bitcoin, but man, that stock's awful. MSTR is that symbol. If Bitcoin goes up, it's going to go up though. They're very highly correlated. So,
Mm-hmm.
um, obviously buying Bitcoin is probably the best way to take advantage. So but if you don't have a crypto account and you don't want to open one, there are some stocks you can look at to kind of capture that upside. So,
Yep.
um, yeah, anyway, Bitcoin constructive for the first time in a long time.
And then here's kind of our favorite chart. I mean, it's not good for the economy or anyone looking to borrow money, but 10-year Treasury broke out of that prior high, consolidated, and it's looking like it wants to go a little bit higher. And that is not bullish for stocks. Or if you were looking to buy a house, the house value probably will go down, but you're not getting a cheap mortgage.
Yeah, I mean, this is probably the most important chart in the market. I mean, it's one of the most important prices for any asset price globally. And yeah, it looks like it pulled back to the trend line and held. Now running higher. So I think this could easily break over 4%. And as it does, tech stocks are especially going to get hurt. So look out if you're long the Nasdaq, you might want to be careful. That could easily send the Nasdaq to a fresh low for the year. I sort of expect that it will, and I'll have to see what happens. But you know, the 10-year yield is still lower than the 2-year yield. So not a lot of people are going to be buying the 10-year yield when you can get a higher rate for 2 years, and so that gives this thing room to go even higher. If we want the yield curve to uninvert itself, if that's really a word, the 10-year needs to go much higher. Because right now it's it's still not higher than the 2-year, which we'll see on the next slide. So definitely room to go up.
Yep. And here's just what you're talking about. So yield curve inversion. So rates on 10-year are lower than those on the 2, and that is not a positive sign. So kind of the best indicator of a recession. And right now we're hitting record lows. So just not a bullish thing
Last
whatsoever.
Now that I think of it, last time I checked, and we've been buying a lot of 3-month, 6-month, 9-month treasuries. But last time I checked, I don't think the 10-year was even higher than the 6-month treasury. I think they're basically about flat. So you could loan the government money for 6 months and get about the same yield that you can get loaning them money for 10 years. It makes no sense. And it's really bad for the economy when stuff like that happens. So,
Yep.
um, yeah, if you've got some cash you don't really want to put into the market yet, 3 and 6-month treasuries are, I think, one of the best places to park a little bit of cash right now.
Yep. And as a result of these high interest rates going up, the US dollar is looking really good. So a lot of foreign, countries like to put money in the US if the rates are more competitive and the dollar's getting stronger because of it. So just
If you want to earn the US 10-year yield, you gotta have dollars to buy it with. So we don't accept Chinese yuan or renminbi for bonds. You gotta exchange it to dollars first, which increases demand for dollars. And there you go. That's what happens when demand increases faster than supply.
yep. And then all that really comes together so that you've got a 30-year mortgage at 6.66%. So
Mark of the beast.
yeah,
Look out.
uh,
I'd
terrible
be
number.
I would be I would be I'd be paying for a different rate. I'd say, could I pay 6.67 or can I give you some points to have 6.65? Because I don't think I want the mark of the beast on my mortgage loan for the next 30 years. I'll take something else.
Nope, financially, and if you're superstitious or anything, not good. So um, here's just our chart. You can go back to other presentations we've done to get a better idea, but just showing you can have big rallies within a context of a bear market. So do not be surprised.
That's it.
And then Shane, what do you got here?
Well, I don't know what TradingView did with their Fed balance sheet chart, but it hasn't been updated since September 14th. So I just went out to the St. Louis Federal Reserve site, the Fred, which is an awesome website. and they have lots of great charts and all types of good data. So if there's something you want to know about economic data, you can usually find it there. So anyway, the past couple of weeks, the last 2 weeks of September, the Fed reduced the balance sheet by $37.19 billion, which is their biggest reduction so far. I mean, you can see the line, the blue line kind of, I don't know if I would say accelerating to the downside on the right there, but it's definitely the biggest move lower over a 2-week stretch that we've seen since the Fed has started to kind of reduce their balance sheet. The big problem is that even though they dropped it by 37 billion in the last 2 weeks of September, for the month of September, it only dropped 30 billion, which means it actually increased for the first 2 weeks. So they were supposed to reduce the balance sheet by 95 billion in September, which you can see the red arrow. It says we will continue reducing its, the Fed will continue reducing its holding of treasury securities and agency mortgage-backed securities as described in the plans for reducing the size of the Fed balance sheet that were issued in May. Well, in May, they said 95 billion a month starting in September. So they did less than half of that, about a third, really. So if the Fed was reducing the balance sheet faster, rates would be even higher, the stock market would be even lower. And so, you know, who knows if they'll ever get to 95 billion a month. It's supposed to be 95 billion a month or up to 95 billion a month. September, October, and November. And I don't know if they have any projections for beyond that, but they never got to the 47.5 billion they were supposed to reduce by for June, July, and August. They never even got close, and now they're not even close to the 95 billion. So they've got room to let more assets roll off the balance sheet. I think they should. I wish they would. But again, that would mean more pain in the markets, both stocks and bonds. But it would probably have a greater impact on inflation overall. So, you know, we'll see what they do, but they're not doing what they said they would do. That's for sure. Balance sheet's finally coming down, but still up for the year.
Perfect. And then here, I think, Shane, you did a little math on what the Fed funds rate should be going forward. So tell us about this.
Well, so there's a lot of numbers on this chart. I'm gonna need you to kind of move your mouse. I'm gonna go through them like, yeah, from top. I'm gonna start in the top left. So at the very top line of the top left chart, right, quadrant 1, if we want to call it that, it says in the title of that chart, CPI declines by 10 basis points month over month. Do you see that, Kyle?
Mm-hmm.
No, you're not
Well,
hovering over it though. You see at the very top where it says CPI declines, the very top line of that
oh, there we
chart.
go. Yeah, it's
There you
blocked under
go.
my toolbar.
All right. So this assumes that CPI declines month over month by 10 basis points, starting, you know, effectively immediately. I don't necessarily think that that will happen. But that would be like a best case scenario for CPI to start just immediately falling by 10 basis points a month. Since 2010, including this year, month over month has averaged 20 basis points. So CPI has increased, prices have increased by about 20 basis points a month on average since 2010. So a decline of 10 basis points a month is very unlikely. I just don't think that's going to happen. So again, sticking with the top left chart here, if CPI, can you put your mouse over the CPI column in that chart?
Yeah, right there.
Yep. So if CPI declines by 10 basis points a month, can you just leave it there? It will drop from the current 8.3 to 7.7 to 6.7 to 5.8 and so on. At a month over month decline of 10 basis points. And if it kept doing that, you can see in the blue box there that we would actually see deflation in the economy by June 2023. So as good as it would be for inflation in the short term, you can't expect this over the long run because deflation is a big problem for economies. The Fed wants to keep inflation at an annual rate of at least positive 2%. Because if you thought that TVs would cost less money next year, or you thought your boat would cost less next year, or you thought food would cost less next month, you would be inclined to not buy things. And if people are inclined to, there's no incentive to buy things now, the economy grinds to a halt. So the Fed does not ever want to see year over year deflation. It hasn't happened very often in the history of our country. And when it did, it was during the great financial crisis, which was a big problem. So even if CPI declined month over month in the short run, what would happen is before it went negative for the year, the Fed would end up cutting rates in a big way. So anyway, I don't think this scenario is very likely, but if it happened, say just in the short term, in a perfect world, CPI could decline by 10 basis points a month until January. And if the Fed hikes rates, so on the left, the second column from the left, it says rate increase, we would get a 75 basis point increase in September, which we've already gotten. We're now in October. This calls for them raising rates by 50 basis points in November, 50 basis points in December, finishing the year at 4.25, and then raising one more time in January to 4.5. If we did that, the real Fed funds rate, which is the far right column, would finally be positive for the first time since, I don't know, a year, probably a year ago at this point. And just to be clear, why is that important? Well, the Fed has never stopped a rate hike cycle with a negative real Fed funds rate. So that's not to say that they won't this time. I mean, history is, replete with new things. So just because they never have before doesn't mean they won't this time. But that's kind of what we're looking for, is that once they get to a positive real Fed funds rate, where the Fed funds rate minus CPI is still a positive number, that's probably the most reasonable expectation for when they will pause and at least stop hiking rates. Until then, I think it's very likely that they continue hiking interest rates. So so January of 2023 is kind of the earliest that I could see them hitting the pause button on rate hikes. And again, this isn't my base case. This is just a potential, a potential. So if you look below that, in the chart below that, the title says CPI is flat month over month. So yeah, in just the top line there, it says CPI is flat month over month. Kyle's not doing a very good job of
This
his
one right here.
mousing. Flat month over month. And in this scenario, with the same rate increase schedule, February of 2023 is the first time at which I could see them saying, okay, no more rate hikes, which technically is January because there is no meeting in February. So, technically they would not need to hike again after the January meeting, and Fed funds rate would be positive by February. And so, this is just one other scenario. I think flat CPI month over month in the near term is pretty likely, but again, you see that in the long run by August of 2023, year over year CPI is 0%. So again, you're not incentivized to go out and spend money in that scenario. You might be waiting and seeing if prices drop next month, and that is not what the Fed wants you to do. They want you to go out and spend. Kyle, can you click like at the top of that, just anywhere in that blanks? There you go. Now we don't have the top left one highlighted. All right, so now in the top right area, the title says CPI grows by 0.2% month over month. And the Fed hikes through March. So they need one more hike to get it done in this scenario, and they end up hiking rates by 25 basis points in March. If they do that, the real Fed funds rate goes positive again, and you can see that in the long run, CPI tops out at 2.4, or I guess bottoms out and flattens out at 2.4%. I think this is a pretty reasonable expectation. And again, 20 basis points, or 0.2% is the average CPI month over month rate since 2010. So I think that it's a reasonable expectation that CPI could go back to the 20 basis point month over month growth, and the Fed will hike until March of 2023, and then they will pause, wait and see what happens with the economy. By then we should have the yield curve should be uninverted, and we should see real positive interest rates across the curve, which is a stated objective of the Fed. So and then the bottom right quadrant is CPI growing by 33 basis points month over month, and the Fed would have to hike in that case through April, so one more additional month from the prior one we looked at, and by May, the real Fed funds rate goes positive. In that scenario, you can see that long run CPI flattens out at 4%. So 33 basis points month over month equals about 4% year over year. And the reason I think that's possible is because I don't know if it was in the last Elevate chat we did or maybe one prior, we looked at the sticky inflation items are 4% by themselves. So excluding food, excluding energy, excluding some of the other more volatile measures. Right now, CPI is tracking at about 4% if you just throw those ones out. So those sticky ones are at 4%. They're going to be harder to get to drop. And so if just those ones stuck around at 4%, I think this is also a very possible situation. So, and if oil keeps going up, you never know. CPI could even reaccelerate from here and be, 50 basis points month over month, in which case it'll take the Fed even longer, hiking at 50 or 25 basis points to get real Fed's fund rate to be positive. So anyway, I think it's important to go through all that because this is kind of our best estimate of when the Fed will back off their hawkish rhetoric and be less inclined to raise interest rates. And I think that's about the best proxy for when this bear market might actually put in a bottom. And so at the earliest, this is suggesting maybe January of 2023. At the latest, this is suggesting May of 2023 for the Fed to back off. And I think that's why we're buying 3 and 6 month treasuries, is because I want the money back by then, because I think if the Fed stops hiking rates by then, the stock market will have bottomed and it'll be time to start putting some money to work aggressively. So we're not there yet, and a lot of things can change in the interim, but sometime between January and May of next year is kind of my expectation. Probably March is my guess right now. If you made me guess, I'd say around March, the Fed will have stopped hiking. And another important thing to note here is that, by January, I have the Fed hiking by only 25 basis points per meeting, after hiking by 75 basis points in September and I guess July they did that, and maybe even once before that. So we did 3, I think, 75 basis point hikes in a row. And in November and December, I expect it to be maybe only 50 basis points each time. And then by January, only 25 basis points. And so the market will probably anticipate, or at least attempt to anticipate, a slowdown in the rate of the hiking and call that a bullish thing for stocks. It's not. They're still hiking rates. And so is it incrementally better? Sure. But with the Fed hiking into the economy slowing by any amount, is not a good time to be getting aggressively long stocks. And I guess the last thing I'll say is the market bottom doesn't actually have to coincide with any of this. I just think that's kind of what's likely. So will the market bottom a month before the Fed stops hiking? Sure, it's possible. Might it take until after the Fed stops hiking? His history says that's even more likely. But yeah, so this is more kind of a matrix to get an idea of when we might be able to start aggressively buying stocks again. We're not totally out of the market. We have some longs on just in case the market wants to put in a bottom tomorrow, or in case it already put in a bottom last week. Who knows, right? We don't ever know for sure. And so we'll be watching pretty closely and updating these forecasts to get a sense of when we think we can safely put money back to work in the stock market. So Kyle, questions or thoughts of your own on that? I know that was kind of a lot.
I think it's good, and it is. I think the big takeaway here is how does the Fed level off where inflation is and where rates are? Because you just cannot continue going forward with inflation much higher than where the Fed funds rate is. So where those two intersect, that's about that point where, the Fed would be likely to back off, but that does not time the bottom of the market. It just makes, excuse me, an environment, I think, that's a little more bullish at that time.
Yep. Cool.
So perfect. Well, here's a chart you brought up. It's pretty interesting, but Australian Central Bank already kind of backing up a little bit. Are other central banks going to follow?
Yeah, and the Bank of England, which it doesn't show here, they backed off of their QT, so they were supposed to be letting assets roll off their balance sheet, but they had a nice big crisis over there a couple weeks ago, and so they ended up buying a whole bunch of bonds from pension funds that were being forced into selling them to make margin calls. So even though the Bank of England's hiking their rates, they're now doing quantitative easing by buying bonds. So they're kind of offsetting all the work that they've done in hiking rates. And this is why the dollar just keeps racing higher, is because the Fed is raising rates faster than everybody else. And so that makes the dollar relatively stronger than all of these. And then you got the good old European central bank down there in green, not even in the race yet. So they got a ways to go. But if the Fed does begin to back off and the other central banks continue to raise it all, it should put a cap on the dollar, and the dollar will start falling whenever it is that happens. The Fed has hiked faster and further, so it only makes sense that they will stop sooner than the rest of these on average, and the currency situation will begin to revert a little bit, which is bullish for stocks. If the dollar begins to fall versus the euro and other currencies, that will be bullish for the stock market too. So
Yep.
we'll see what happens.
And this I just laugh every time when you see the government here, California on this one, handing out money when there's inflation, which is the exact cause of inflation. So they're just fighting the central bank trying to get votes, and it's not going well when there's more dollars chasing the same thing.
I'm not even going to say anything. I'm just going to do the thinking face. That's all I got. I got the thinking face. Makes no sense.
So then, Shane, tell us about this chart you have here.
Yeah, so this comes from the Felder report. Jesse Felder, very smart guy. I get a lot of good nuggets from this guy. But the highlighted part in the top left shows that there's kind of a bearish trifecta, as he calls it. Rapid rises in the dollar, rapid rise in interest rates, and rapid rise in oil prices tend to negatively affect earnings over the next year or so for like S&P 500 companies. And so what you see in the chart is kind of an analog of the average of all the bear markets. Oh, excuse me, not all the bear markets, but the 1973 to 74 bear market, the 2001 to 2002 bear market, and the 2008 bear market. It's the red line is all of those kind of averaged together to their ultimate bottom, essentially. And the blue line is today's bear market measured against those. So you can see where it says you are here. If we follow the same trajectory as those other three bear markets, there is a lot lower to go. In fact, we're only probably halfway through this bear market. Again, history doesn't have to repeat itself. Just because this red line goes much lower doesn't mean that the blue line will follow it. But it is something to consider. And every time you see some bullish thing or somebody out there writing about why this is the low and you should buy stocks right now, just know that they might be wrong too. And history would argue that there could easily be a lot lower to go. So when I say now is not the time to aggressively buy stocks, that doesn't mean that now is not the time to buy any stocks of any kind in any amount. It's just not a time to get aggressive doing it. So could be a lot lower to go here, and time will tell.
Perfect. And then here, sentiment cycle. This is always a good one. I like this. This one right here, panic. That's not the time to sell. You need to sell when you're here, when there's enthusiasm.
Yep. So. When everybody tells you the wrong thing to do is sell, that's when it's time to sell. But yeah, this is kind of the cycle. I mean, there's just four major cycles, and right now we're actually kind of in the discouragement area, I think, where people have already kind of panicked and sold a bunch of things. Um, and we've made some lows, and then we've made a fresh low, and now people are just like, after that 20% almost bear market rally that failed and then made a new low, people are feeling pretty discouraged, is my bet.
Hmm.
It doesn't mean there's not another round of panic to come, by the way, because sometimes the final part of the bear market is the worst and nastiest to the downside. But I don't sense a lot of panic out there right now. I sense mostly discouragement. So either the panic hasn't come yet, which is terrifying because that means we got a lot lower to go, or it's already happened and people are just discouraged now. So if you go to the next slide, we'll kind of see a different. Oh shoot, one more slide. Must have gotten them a little out of order. Yeah, here's the one I meant. So this is Justin Mammoth's sentiment cycle. You can see I've highlighted the discouragement area down there at the bottom, right? Where you make the you do a nice rally and then you make another new low. And so I think we're probably in that area. And the thing to note is that, if you look out in the long run, you can probably get away with buying stocks here. And in the long run, they'll be higher, a year or 2 years from now, or maybe even 6 months from now. But it usually doesn't go that way in one straight line. So I think we're probably towards the discouragement area where we're going to bounce around near the lows for probably an extended period, right? Like maybe all the way until March, April, May of next year. And then the Fed will back off of its interest rate hike cycle, and you can get a little bit more bullish. So this is kind of where I think we are in the market cycle right now, or the sentiment cycle. And I don't know, Kyle, you have any thoughts on that?
I think I agree on that one. I've kind of had those moments where it seems like there's been panic, and now it's just kind of discouragement. But yeah, this it does a great job illustrating, because here is where everybody's saying, the wall of worry, oh, it can't go higher. You get that sell off to here, but look, it's higher than there, and this is a really
Mhm.
nice entry. So I'm
Yep.
hoping for that. So I'd love to see a nice spot like that show up.
Yeah. You go back to slide 22 real quick. So this is one more reason to maybe put some money to work, because as bearish as we all are, we might be wrong. And there is some evidence that, this could be a good time to throw some money into the market. So October 13th is that low. And this is just the average trading day of the year. Shows seasonality. We looked at a seasonality chart, I think, last week too. So on average, from October 13th to the end of the year, generally, this is for the NASDAQ, generally, you see a nice big Santa Claus rally. So that's one reason to maybe put a check in the bull market column, or not bull market, but bullish column.
Hmm. And then this one, if you want to talk about the thrusts, I think that's an important point.
Yeah, so I mean, this is from Sentiment Trader. These guys do awesome research, and I would recommend a subscription for just about anybody. Um, on consecutive sessions, more than 5 times as many securities on the NYSE went up as went down. So when most of the stocks, right, 80% or more of the stocks are going up on the Nasdaq, that's usually indicating a bullish environment. They call it a thrust. And so the highlight here is kind of obvious, but when you see these thrusts, the positive, or the 1 year return is always been positive. There's never been a signal that wasn't positive a year later. There are plenty of times that 1 week later the market was down, or 2 weeks later the market was down, or 1 month later the market was down. So it doesn't necessarily mean that the bottom is in, but looking 12 months out from one of these signals, the market has never not been higher. 100% of the time it's been higher. So if your time frame is 1 year, if you could just, go to sleep and you don't look at the performance of whatever it is that you buy today over the next 1 month or 2 months or 3 months, if you don't care about any of that, you just care where it's at in a year, might be a good time to put some money to work here as well. So a couple of reasons to be bullish.
Yep. And this one I mentioned earlier, but just Wall Street Journal article, and this is kind of everywhere, but OPEC did not play ball with the US and decide to increase production. And it this should be the Babylon Bee article really. But White House considers retaliatory measures such as suing cartel on antitrust grounds. Hey, good luck with that.
The cartel plays by antitrust rules. Come on. What antitrust rules? Does the UN do antitrust rules? I don't know.
But
Is there
yeah,
even any antitrust rules in the United States when you've got companies like, too big to fail, for example? Isn't that the same thing? I guess not.
similar, but I mean, this by definition, they're a cartel and they don't operate by the US law. So it's just funny.
Yep.
And here is the Babylon Bee article. So, Biden calling Dave Ramsey to figure out how to pay off that debt. And, it is funny because as you read the article, it's, well, you gotta, eat just rice and beans and live by, nothing. And that is not what's happening. We had the Inflation Act that passed and they're just trying to run the money printer and yeah.
That just makes everything cost more. So
Yep.
that's how you pay it back. I mean, you know how you pay 31 trillion back? You print 31 trillion, make every single one of those dollars worth a little bit less, and now you're paying back your debt with money that's not worth as much. So that is how they will do it. Make no mistake about it. That's why you got to be invested in stocks for the long run, is because you have to be able to earn more than the government will print you out of, or you won't stay wealthy. I mean, that's just what it boils down to. So that's why we have to invest in stocks. Doesn't mean we always have to aggressively be buying them, but in the long run, there's no better wealth building tool than the United States stock market, period.
Yep.
Doesn't exist. So this bear market won't last forever, but I don't think it's going to be over tomorrow either.
Yep. So perfect. Well, that's all we have this week, Shane, as
That's all we
always.
have. That was 26 slides of stuff. That's all we got. Not
Yeah,
much more.
we covered quite a bit today. So thanks again for your time. I will see you next week. And thanks everyone for watching. Please subscribe and like. And yeah, we'll see you next week.
Thanks, Kyle. See ya.
Yeah, bye.